Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the ongoing battle between the Federal Reserve and the White House over mortgage rates. Plus, we'll talk about the CPI report and purchase apps. Logan, welcome back to the podcast after our amazing time at the gathering.
Sarah Wheeler, I've got something to say to you. I want you to tell everyone that's listening, what was the name of the golfing event that we had, which was sponsored? What did they call it? What was the marketing right on the golf course?
We had this we had some very fun social events. Rate sponsored this event, and I was sure, in fact, I made Logan go over there because I was going to take a picture with the sign that said putt putt, and it said mini golf.
Mini golf. Mini golf.
I got over there and I was like, I literally brought you over there so I could take a picture of it with you in front of it and be like, ha ha. And then you're like,
Sarah Wheeler, they say one man's invincible and the other man thought he could fly. When they both jump off an airport or an airplane, they both die. They think they're invincible when you could go head to head with Logan. Just remember that was done on your home field in your event. It was all this hype, all this putt, everything out there, and the thing was called mini golf.
Although many people at that event came up to me and they're like, putt, and they like put up their fist to do a fist bump. So
it is, but on this day, we will remember it called mini golf on your home court, in your event, in your thing, in front of you. You said, you got to come with me. I got to take a picture of you. And I'm like, okay, all right.
It's
true. It was mini golf.
It was a humbling moment for me. It was a great event, though. That was just part of it. You did a great job as our headliner, our speaker there on economics. That was amazing. We had a lot of great speakers, and the people who came, the connections, the generosity, I think, of the speakers to get up there, 15 minutes, not a lot of time. People flew in from all over. Incredible event.
Yeah, I think when I went on stage and said, has everybody heard that it was the greatest sellers to buyers gap in history? And I showed my chart. And it was basically, I said 2005 and 2007 says, hold my beer. So yes. we got a few.
You do love trolling that data, that headline, that specific headline from Redfin, right?
Oh, the Northerners will never forget the Red Wedding, Sarah Wheeler. I'm never going to forget that one.
I don't think that quite rises to that level, but okay. So let's talk about some other things today. We're going to get to the inflation. We're going to get to purchase apps. First, I want to talk a little bit about the Fed. What would you say? There's lots of talk right now.
What's the term, Sarah?
I don't know. Which term? What are we talking about?
I mean, tariff deranged.
Tariff derangement syndrome. Oh yeah, okay, syndrome. That is a term some people.
That was the talk of this week. Of course, it's inflation week, and it's funny because the Set and other people are saying, look at the inflation data. What are they doing? What's the Fed doing? And I was reminding everyone, because we're doing this Thursday morning, so the PPI inflation came out today, tamer than what people thought. The CPI inflation came out tamer. It looks like a global pandemic. It looks like a very inflationary global pandemic and the disinflation. The whole 1970s things didn't happen. All these things about breakaway inflation. The starting point of 2024 would be the second or third wave. None of it's here, right? Tariffs are taxes. Shortages can be a problem for inflation, of course. We saw that during COVID. But it gets into a point where I think it gets very interesting for the Fed, for Jerome Powell, because this is it. He's on his last year. And the Fed presidents and people like to think of legacy and how the Trump administration was going to attack them. I think J.D. Vance retweeted one of the inflation headlines and said, this is malpractice by the Federal Reserve. So as we have talked about from the start, what does the White House want? The White House wants a lower dollar. They got that. The dollar is at a multi-year low right now. Energy prices had fallen. It's perked up a little bit recently because of headlines with Iran. But the 10-year yield, I think for them, if they could get it between 380 to 4.25 and just have it stay there, they would be fine with that. And if you get 1% rate cuts into there, remember 65 to 75% of where the 10-year yield and mortgage rate can go is Fed policy. By the way, Sarah, really remember when Moody's downgraded our debt?
I do.
Okay.
Yes.
And we were like, the media was like, oh my God, the bond vigilantes. The bond vigilantes are going to do it. The market is scared of our federal debt. This morning, the 10-year yield hit 435. And for those who don't know what I'm talking about, 435 to 470, unless the labor market's breaking where Fed policy is. That's why I always talk about where Fed policy is, that is an acceptable range because the Fed, it wasn't about inflation. If it was about inflation, they would have stuck to their original call saying we would like the Fed funds rate to mirror 3, 6, 12-month PCE inflation, core headline, whatever you want to pick. Headline came in at 2.1%. We're 3.5% Fed funds rate. They would have just stuck to that game plan. It would have been much better. But they're here. And I said to a lot of people this morning, hey, guys, if there was no trade war, they'd still be doing the same thing. They'd be still be, the labor market isn't breaking. Consumption is fine. They were talking about we're not far from neutral policy before the trade war even got on. So I can understand how the White House is going to frame this. But, oh, Nelly, it's going to get interesting in the second half of 2025 because let's do two hypothetical theories here. Let's just say inflation never really took off. And everybody's going to say, look, Powell was wrong. This is all ideologically driven. He doesn't like Trump. There are a few Fed presidents who don't like Trump. And they did this, this is malpractice. They could go on a full court blitz then. Or, the tariff percentages, tariffs are taxes, right? So a tax on the company or the consumer, that's what it is. And we can see softness in the data and the inflation data start to perk up a little bit, where that can be a little bit more problematic maybe for the economy out there. And the Fed just stays, we're going to wait. Either case, it's an inflection point right now for them because a lot of people were told that tax cuts, deportation, inflation's going to take off. Here, all these things that we're here in June, and the growth rate of inflation felt like it would have, anyway. Still, again, Fed policy, pound the fist. It's not debt. It's not anything like that. It is Fed policy that is keeping this. And it just gets more interesting in the second half out there, I think, just for them, because like the Cleveland Fed president said, I don't know what's going on, but we'll play catch up if the labor data starts to get weaker. So, it's going to be a fiery, fun second half of 2025.
Do you think, in the past you've said, they were old and slow, knowing that it's based on labor triggers and we haven't seen the labor triggers yet. Do you feel like the Fed right now is already behind?
Let me give my perspective. I would not have raised rates above 4% to start off with. I would have done basically what the Federal Reserve would have done before the spiking of the eggnog. I would have said neutral policy would have been basically worth 3 to 6 to 12 months. But we have to remember, the Fed panicked toward the end of 2022, and they didn't think the growth rate of inflation was going to fall. And they just said, well, we are going to, technically they were forecasting a recession in 2023. Well, if the recession comes, we'll cut rates because the labor markets. Well, guess what? The labor market outperformed in 2023, but the growth rate of inflation fell. And I think they got stuck. Like my personal belief, the Fed got stuck because the growth rate of inflation fell, but the labor market got approved. So they just basically hid behind the labor market for this period of time. Now, we brought the labor over inflation toward the end of 2022, but if you look at it, that's the dual mandate, right? So if they could probably go back, I don't know this for sure, but maybe if they went back in time and knew what was going to happen with the inflation data, they would have stuck to the original. But they went there and they stuck to it. So we're here. This is where we have to deal with. But as always, the Fed still says they are modestly restrictive because the Fed funds rate is here and the growth rate of inflation is down here, but the labor market is starting to show a little bit more stress. Like the hirings aren't really, that good anymore. I mean, for the first time in many years, the year-to-date job creation is underperforming, which that wasn't the case the past few years. And I think it's a tough bind for them, because if inflation does not pick up for the next 6 to 7 months, and boy, they're just going to hound and go, look, you panicked, why aren't you? And even if it does pick up and the labor data gets softer and worse, people go, you're too late. So they kind of put themselves in this corner, right? So you got to go with it, except not all Fed presidents are in that camp, right? Waller, who used to be a hawk, kind of isn't. Bowman, who used to be a hawk, isn't. The shadow Fed president is still in play in this regard. So it becomes interesting. We did that podcast, the Civil War between Fed presidents. So you're starting to see people take their corners, right? And we're going to take it from there. But man, it is going to be interesting out there, because you could understand if ships weren't being sent over and goods weren't being there, you would have a shortages of stuff to sell. So that is, in a sense, inflationary. How fast we can get everything back and going again, that could be a delay impact. So nothing is smooth this year, right? There's tariff on, tariff off, Godzilla tariff, no Godzilla tariffs. This policy that was basically looks like the same thing before, it's chaos, right? But in this environment, the Fed has to focus on what they believe in. Again, to me, it was always from day one, since the spiking of the eggnog in 2022. By the way, I cannot wait to find that person. Oh, we're going to TP his house, him or her house. We're going to throw eggs at it. We're going to be hooligans, right? And this is it. This is just where we are at. And I always tell people, guys, if there was no trade war, we'd still be having this discussion.
We also had, so here you are looking around to see, okay, who's going to be the shadow Fed president? Because that's a strategy that Bessent talked about in the fall before the election. You've made a good case that this is what President Trump is probably going to do. And then we had, some rumors this week that it was going to be Bessent himself who was going to become the shadow Fed president. Of course, he is already Treasury Secretary. And what was his response? He came out and basically squashed it, right?
Well, a lot of people would be happy if Bessent took it. But he said that he wants to be Treasury until 2029. Okay, I think in 2029 he's done. But in this context, you could see in the background what people want the Fed to cut rates. So we've always said three things: lower dollar, they got; lower energy prices, they got; lower 10-year yield, they didn't get. So this was always about the 10-year yield. And again, if you look at the history of Fed policy, the 10-year yield, the mortgage rate, it all looks, it's consistent, right? That's not the case. I think it's not framed that way. And that's probably, that's my fault that I did not frame that earlier. But I think now people are starting to understand that. So we'll see. I think maybe you'll get some more rumors, but really there's only three people. There's Kevin Warsh, which a lot of people on Wall Street don't like, but he's always in the background with Trump. So that's number one. And he always bashes the Fed also. Waller would be a very good choice, because they just see him as, a Federal Reserve person. And he's already kind of gone into the labor over inflation, tariffs are a one-time hit. We can look through that. So that is somebody that the White House maybe can back up. But then again, if they choose him, is the shadow Fed president a little bit less relevant because he's at the Fed. And then Michelle Bowman, who just got vice chair, she's also somebody that was a hawk but has gone to labor over inflation. We got some people on the Team Logan side now. Okay, so that were very hawkish on inflation. It's funny how people just all of a sudden, they go, we're labor over inflation now. But so those three would be the headlines. But again, every month that goes by, every week that goes by, it just gets more interesting. And I think when the CPI report came out, Trump went on and said, we need a 1% rate cut right now. The interest of debt needs to be revised. By the way, that was, again, still to this day, everyone, that was a gimmick. That was a marketing gimmick that the conservatives did with their social media people, that we needed to create a recession to refinance our debt. That, oh my God, all this debt is about to come due and the bond market is just going to, look at the bond, 10-year yield, 4.35. Come on. So I thought it was a good cover because, again, a trade war, full-blown trade war can be problematic for business investment. And we saw that in the last one. So they use that as a clever cover for like, hey, we need rate cuts because we have so much debt we have to redo. But in this case, you don't get a 1% rate cut unless you have real problems in the economy. So that's not going to be a legitimate theory. But we'll see. I mean, I don't see the tariff percentages really coming in through the goods yet in a meaningful way. Nobody looks at that. You shouldn't because you have a life. So we'll see how the second half goes. But you can see what happened. The first half, people are like, what? Where is it? Where's the inflation? Where's the breakaway? So that's why the tariff deranged syndrome is coming out by some of the people.
Okay, so this week, also some very interesting data. Purchase application data. Okay, we have to, no one cares about purchase application data, but it's actually a hugely important data line. I know that now because I interview you. Before that, really, I would have said the same thing. So tell us what we got this week.
So I remember a few weeks ago, I was telling you, I said, look at these, man, we're going to get some really, really easy comps every week coming out because, last year you could see this was declining noticeably. If you did not know how purchase application data works and you saw this headline, 20% year-over-year growth, 10% week to week, people are like, what? And I get it. Like, if you don't track things, you see that headline, you're thinking, oh my God, that's very noticeable, But again, purchase application is a trend survey. So we want to go over all the data this year. We have 11 positive week-to-week trends. We have 8 negative. We have 3 flats. Preferably, I would have loved to see that 3 weeks of decline when mortgage rates spiked up, Godzilla tariffs, the ripping of the face, reversal in yields. That gave us 3 negative weeks. Now, even though the year-over-year growth was still there the entire time, if that was a positive and we had 14 positive weeks, 5 negative, 3 flats, the year would have looked better, but we lost kind of that month momentum. But we're back up here again. 10% week-to-week growth, 20% year-over-year. Again, very low comps. Think of it very easily. New listings data is up year-over-year. Rates fell this year instead of rising throughout the year. So if you look at the comps basis and what happened with rates and new listings, you could see how purchase application data could be positive. And I think that should be the peak growth rate of this year because the comps are really easy. So 20%, yes, is material. I always say if this data line is really doing good, it's 15 to 25% year over year every single week. No equivocation. Boom, boom, boom. Especially working from a low bar. So 19 straight weeks of positive year over year growth, 6 straight weeks in a row of double digit year over year growth. And just remember, July to November, for the months of June to October, I always have to say that because people don't know the existing home sales is for the month behind. So it's a lagging data line. If home sales just stay flat, you're going to see year-over-year growth for 5 straight months. Context, right? So we're keeping an eye on this because purchase apps look out 30 to 90 days. It might even take 4 months before it even hits the sales lines. We've had some very awkward existing home sales prints when we see growth. It tends to sometimes go into 1 month or spread out. So we'll keep an eye on this going out in the future. But yeah, it is the first positive year. Nobody else is talking about it. I'm looking for anybody else that wants to. Nobody wants to touch this, right? Nobody wants to touch it. They're like, and I totally get it. Even like a really good example. One of my Wall Street trader friends. He's like, he looks at the new home sales reports. He sees all these surveys. The survey looks like new home sales is crashing, right? You just like it's really bad. And then I retweeted him. I said, look, hey. We just hit a multi-year high in new home sales, and the purchase application data for the new home market is post-COVID highs. So what's going on? Surveys are down, sales are up, surveys are tilted for smaller builders, Bigger builders are just paying down and closing these transactions when they can. They sell homes as a commodity. That purchase application data is very seasonal. It's at the peak of the seasonal part. It's going to decline like it does every year. But they live in a sub 6% world and they manage their stuff. And we're just basically in a sales range for years. So it's confusing. I still think today, like, people just don't know what to make of the purchase application data. Right? But if you look at the history of purchase apps and sales trends, they tend to move together. No equivocation, 100%. But it can get confusing with the percentage increases on a year over year. Like, we're not getting 20% growth in sales. You got to take it as a trend. And this is why when we do the tracker, we religiously, like, I literally handwrite purchase application data on a book.
I know.
Right?
I've seen it.
I am going to, it's somewhere in here. I am not kidding you. I have every year just so I can, keep it in my mind about what the data was doing, right? Because you have to track it differently. It is a trend survey. And if you're confused, I totally get it. Because if you look at that data line, if you did not know anything else, you would think, wow, the housing market is doing good. Right? There's less cash buyers this year, but this is why everyone should read the tracker, because we correlate the purchase apps with our pending sales. And what happened last year is that purchase apps were getting better. Nobody cared about it because they saw the low volumes. They saw no year-over-year growth, so they ignored it. But you tag that 30 to 90 days out with our pending sales data, oh my God, a couple 100,000 more home sales. So we just keep an eye on it. But if you're confused, I totally get it, because even my smart friends are like, what the hell is this?
That's why we have you, Logan. You help us to be less confused, and so appreciate your time. So appreciate the wrap up here. We will talk to you again soon.
Pleasure. Last thing, Sarah. There is a video. If anybody wanted to see a video of Sarah Wheeler being brought up to the mini golf side, I did take it, yes. And I told her, I said, Sarah Wheeler, you were going to try to rip me on this. And here we are. So I just wanted to look at that. What does it say? Mini golf.
Yeah, that was a pretty great moment. Also, I think it's funny that in this podcast, I've been Sarah Wheeler, not Sarah. I've been Sarah Wheeler like 4 or 5 times. Like,
whenever you're being scolded, it's Sarah Wheeler. And by the way, there is a petition. There is an online petition to get me on 4 times a week. Somebody created a petition. Find it, sign it, send it to HousingWire. Get Logan. We're going to eventually make this 5 days a week. And eventually it'll be 7 days a week. It'll be 24/7, twice a day. The chart daddy.
As I have said to some people, I think you just want a Truman Show, only it's the Logan Show. We just follow you around.
If I could walk around with a 10-year yield chart right behind me, 24/7, I would do it.
Yes, it's like, here's Logan on a Friday night looking at charts. Here's Logan in the middle of the night waking up to look at the 10-year yield. So yeah, it'd be fascinating. We'll see. We shall see, Logan. Thank you so much for being on. Appreciate you.
Pleasure.